Imagine you've spent years paying next to nothing on your student loans, maybe even $0 during some months. You enrolled in what many called the most generous repayment plan in U.S. history. Then, one day, everything changes. Payments go up. Loan forgiveness? On hold. What was once billed as relief becomes a financial trap. Today, we unpack why the popular SAVE plan is ending and what it means for millions of Americans. In 2023, the U.S. federal government, under the previous administration, introduced the SAVE plan, or Saving on a Valuable Education, as a part of efforts to ease America's student loan burden. SAVE was more than just another income-based repayment plan. It was, for many borrowers, a game changer. Monthly payments were often slashed dramatically, sometimes to zero for low-income borrowers. Interest wouldn't accumulate faster than payments, and smaller loan balances, especially undergraduate loans, qualified for forgiveness in as little as 10 years. For millions, especially recent graduates, public service workers, and those with manageable loan balances, SAVE offered hope. But that hope is now on the verge of unraveling. This week, the U.S. Department of Education announced a proposed settlement with the state of Missouri and several other states, legal action that challenges SAVE's legitimacy. Under this agreement, pending court approval, SAVE will be shut down. No new enrollments, no pending applications accepted, and existing borrowers will have to transition to other, older repayment plans. In short, millions of borrowers who counted on low or zero payments or fast forgiveness now face abrupt change. Around 7 to 8 million borrowers are enrolled in SAVE. The settlement doesn't just freeze the plan temporarily, it marks an accelerated end. What was already set to expire by 2028 under federal law may now vanish much sooner, depending on the court's approval and the speed of transition. Let's rewind for a second and look at why SAVE had captured so much attention. Lower payments. Instead of the standard rigid repayment schedules, SAVE tied monthly payments to a borrower's income and family size, dramatically lowering monthly costs for many. No growing interest burden. Unpaid monthly interest was covered by the government when the payment wasn't enough to cover it, so balances wouldn't balloon. Faster forgiveness for small debts. Federal loans under certain thresholds, like undergraduates with moderate debt, could qualify for forgiveness in as little as 10 years, rather than 25 years under older plans. Relief especially for vulnerable borrowers, those with low income, working in public service, or burdened by student debt, felt SAVE was their lifeline, a real chance at climbing out from under student loans. For many, SAVE wasn't just a repayment plan, it was financial survival. So why is a plan like SAVE being dismantled? The crux lies in a legal and political challenge. Several Republican-led U.S. states, starting with the Missouri Attorney General's office, sued the Department of Education, arguing that SAVE constituted an overreach of executive power. They claimed it imposed undue fiscal burdens on taxpayers and lacked explicit authorization from Congress. The settlement with Missouri and the other states effectively brings SAVE to an end. The Department of Education will withdraw SAVE as an option, deny all pending applications, and require current enrollees to switch to older plans. For advocates and borrowers, this feels like a political reversal, a major rollback of what many considered a lifeline for students. Critics argue the move penalizes working Americans and throws their financial future into chaos. The end of SAVE isn't just symbolic. For borrowers currently on SAVE, the consequences could be severe. Higher monthly payments. Many will be forced onto older repayment plans, such as the older income-based repayment, IBR, income contingent repayment, ICR, or standard plans, which have less generous terms. That means monthly payments could increase, sometimes substantially. Longer repayment period. The accelerated forgiveness timeline SAVE offered may disappear, meaning some borrowers could be looking at 20, 25 years or even longer of repayments instead of 10. Interest accrual and growing debt burden. For borrowers whose income-based payments don't even cover interest, unpaid interest could now be added to the loan balance again. Uncertainty and stress. With the SAVE shutdown pending court approval and transition timelines unclear, borrowers may feel lost, unsure whether to switch immediately or wait and see. One example, a public school teacher whose monthly payment under SAVE was $373 found herself paying $875 under a traditional income-based plan. That's more than double. That's a heavy blow, especially when wages are stagnant and cost of living are up. The dismantling of SAVE also carries broader social and economic consequences. Education affordability and access. If student loans become harder to manage, fewer people may choose to go for higher education, especially low-income or middle-class Americans wary of decades of debt. Public service and equity concerns. Many SAVE beneficiaries belong to public service professions, nonprofit workers, or lower-income backgrounds. Removing this kind of debt relief to disproportionately harm those already economically vulnerable. Political signal. The move represents a shift in policy and priorities from debt relief and social investment to fiscal conservatism and taxpayer protection. That sends a message about which segments of society the government opts to support. Pressure on alternative plans. With SAVE gone, older repayment plans and possibly newer ones being introduced will face enormous pressure. The transition may overwhelm loan servicers, lead to backlog, confusion, and financial hardship for many borrowers. If you or someone you know is enrolled in SAVE or considering federal student loans, here's what you should do right now. Check your current loan status, log into your loan servicer's portal or federally via studentaid.gov and verify if you're still under SAVE or have been moved to forbearance. Explore alternative repayment plans. The major ones are income-based repayment, IBR, income contingent repayment, ICR, or standard plans. Use tools like the official loan simulator to estimate what your monthly payment will be under each plan. Act sooner rather than later. With the SAVE shutdown pending court approval and transition timelines unclear, borrowers should evaluate their options and choose a new plan, or risk being automatically placed into one that may be worse. Consider long-term financial planning. If your monthly payment will increase significantly, reevaluate your budget. Build emergency savings, reduce non-essential expenses, and plan for possible interest accrual. Watch for new developments. The law may still change. Congress could propose new borrower-friendly plans, or courts could block parts of the settlement. Stay informed. Why this matters, the human story, and political stakes. At first glance, student loan policy may seem dry bureaucratic detail, but for millions of Americans, this is real life, the difference between chasing dreams and drowning in debt. For a single mother working as a teacher, SAVE may have meant the difference between paying rent and skipping a meal. For a public service emergency worker, it might have meant hope, a path to debt-free living after years of modest wages. Cutting SAVE isn't just a policy shift, it's a reversal of hope, and for many, a betrayal. Politically, the decision underscores deep divisions in America's vision for education, debt, and opportunity. On one side, policies prioritizing fiscal prudence and taxpayer protection. On the other, debt relief, social equity, and expanded access to higher education. With the end of SAVE, the pendulum may be swinging toward the former. So, what's the bottom line? The SAVE plan, once heralded as a breakthrough in student loan reform, is being dismantled, potentially within months. Millions of borrowers are being forced to choose between repayment plans with worse terms, higher monthly payments, and longer payback periods. For the borrowers, countless individuals, families, public service workers, This is more than numbers. It's their future. As viewers, what should we take away? First, stay informed. Second, if you're a borrower, act now. Don't wait. And more broadly, understand that policies like SAVE are not just lines in legislation, they shape lives. Call to action, engagement, and reflection. What do you think about this? Is the end of SAVE a necessary correction or a harsh blow to working Americans? Drop a comment below. Have you or someone you know been affected by student loan changes? And if you found this breakdown helpful, please like, share, and subscribe because the stories behind policy matter.